Me go first for the banks.
Hi, just to do a mic test, if you can hear me and see something on the screen, please type something in the chat. Thanks. Okay, thanks. So we'll start in about 1 minute's time.
Yeah, hi. This Paul here. I'm filling up for Minion, because she's actually at the Raffles Medical Briefing. Sorry. So I won't run through all the bank results, but I think in general, what we see is that most of the banks actually more or less report the same phenomena. I think the net interest income is actually growing, but what's pulling most of them down is the other non-interest income. So you can see from all three banks, from DBS to UOB, like you can see the non-interest income is the one pulling, but what's helping all the three banks is the net interest income. And sorry, I just run through again. Again, you can see the same thing. The net interest income is actually rising, but it is the other non-interest income that's hurting. Among the three banks, the one that has done the best was probably DBS. Then second is UOB, and then third is OCBC. Yeah, I think OCBC was the weakest because I think they've got because the prior last year they had a very big gain in net in investments. But anyway, in terms of the outlook, this is how we would summarize for the banks for 2019. Again, we are still positive on the banks. Firstly, some of them are earning almost 5% in dividend yields. And you can just expect the banks to be growing high single digit. I think our EPS growth for most of the banks is a high single digit. And I think the difference this time around for the banks is that the earnings is more stable. Because most of the earnings growth, as you can see, just using OCBC, most of it comes from net interest income. And the good thing about net interest income is that it is more recurrent because you're based off of your huge loan book, and your earnings is not dependent on capital markets or investment gains. So that's why this time around there's better stability and visibility for the bank earnings. In terms of the first quarter, I think first quarter could be affected. The headline numbers could be weak because the problem for first quarter, most of the banks, as you know, it was a very strong quarter for most of the banks. But what happened is that they also had very good fee income and other income. So the only thing is that's the upside that you can get from the capital markets. So in general, we're still bullish on the banks, and we expect a high single digit growth for all in general for all the three banks. Any upside will depend on the capital markets. As you know, stronger capital markets means they will get more fee income from the wealth management business, and of course, you will fill up this gap, this other net interest income, because that's where most of the investment gains are recorded. Anyway, sorry, because Minnie's not around, I'm just giving you a rough summary of her views. Okay, I will move on to Capital with Tara on CapitaLand.
Hi, Tara here. So I'll talk about CapitaLand's and CDL's full year results that were released last week. For CapitaLand, the revenue had a very good showing. This is mainly due to the higher handover of units from their resi projects in China and Vietnam, and rental revenue from some of their newly acquired properties in Singapore, China, Germany, and the US. So some of the new properties that they acquired were the US multifamily properties, and as well as the Germany office asset via CCT. So the positives is that there was a strong bump up in China resi sales this quarter. So sold units and sales value almost doubled year on year this quarter. And this was according to what the management had already guided the previous quarter. And ROE was the highest in 3 years. So consecutively, it's been increasing for the past 3 years, notably from the revaluations and impairments. So stripping out the gains from the Nasim units in the first quarter last year, ROE would have potentially even tipped over to the double-digit range, which is the group's eventual goal anyway. And also, this could be further built up from the boost from Ascendas-Singbridge, the potential Ascendas-Singbridge acquisition. So this had already been communicated in the previous slides that they've communicated that the ROE and the EPS would increase. And also they're operationally healthy on all fronts. On the retail, on a same mall basis, tenant sales across all their geographies, including China, their biggest retail portfolio, continued to record positive growth year on year. And for the office sector, China, they recorded higher than market occupancy. Same for Singapore. Singapore is very healthy, above 99% committed occupancy. And rents also holding very steady. For lodging, their full year RevPAR, which is the revenue per average unit, increased about 4% year on year, driven largely by the Europe, Singapore, and China segments. So the negative is that certain new launches in China still continue to be deferred due to the cooling measures. As you know, there are certain price caps across all cities, including the tier 1 and 2 cities, which CapitaLand is predominantly in. However, we asked the management, and even with the current price caps, they're still able to record a healthy double-digit figure. But of course, they would want to maximize these margins, and also taking into account that unlike Singapore, there's no so-called sell-by date for them to launch and sell the units by. So they are able to work this flexibility within their model. And outlook-wise, it's positive. Healthy momentum is still expected to persist for the remaining about 7,000 units that's expected to launch for the China Resi sales this year. And as already mentioned, the margins would still be healthy even if they were to launch all of them with no hold up from the price caps. And going forward, the anticipated acquisition of ASP will bring in new geographies and new business verticals in the business park and industrial spaces. And also, they have been communicating their long-term targets of 2080 development and investment properties and 50-50 emerging developed markets. So increasingly, you'll be able to see the group pivoting towards the exposure in these markets. And moving on to CDL. So CDL, there was you would be able to see quite a big increase in their fourth quarter. And as you know, this was mainly due to the full recognition of the Brownstone EC last year, as well as the partial divestment of their stake in 2 Chongqing projects. So for EC and foreign projects, they usually recognize fully on completion. So there's lumpiness in the top line, and that's why you see such a big increase, and this was mainly due to the EC recognition last year. The positives for this quarter is that they are still able to command very robust demand for their launch projects, even those launched after the July 2018 cooling measures. So for Whistler Grand, for example, they only launched in November and at a record price of about 1.38 per square feet and that's a record price for that region, and they're still able to achieve a total take-up rate of more than 30%, close to 40%, despite being launched after the cooling measures. And also, similar to CapitaLand, they are also steadily ramping up their recurring income stream. And some of the actions that they've done are the acquisition of the 2 London buildings last year. And these 2 buildings are currently under rented, and there's an upside of close to 30% this year, with one of the buildings having more than 25% of their leases up for renewal this year. So there's upside from their recurring income stream as well. Also from the ongoing AEI at their flagship building, Republic Plaza, and other potential AEI targets. The negatives, as you would have seen from their PATMI line, is that they recorded very sizable impairment losses, about 90 plus mil. This was mainly due to the operating cost structure. So in the US, what they're experiencing is that the labor union is very strong. So this is in terms of the employee wages, and their operating cost structure was unable to budge. Thus, they had to recognize these very sizable impairment losses. So excluding this and on a like-for-like basis, meaning stripping out all the gains from last year, the 4Q18 PATMI would have increased about 17% year-on-year. So you would see on the top left is the table for their resi launches this year. They have 5 launches, including the Sumang Walk EC launch, which is the only EC launch for the year. And I think it's safe to say for this only EC launch, they have very healthy inquiries coming in, and there's already a waiting list for this site. Given that CDL is still largely in the Singapore resi, safe to say that the earnings drivers substantially weigh on the sales efficacy of its 5 launches, and they'll be focused on clearing their already low Singapore inventory. And in terms of land banking, the management had communicated that they'll be more focused on GRS sites more so than on block sites due to the sensitive pricing that they would have to negotiate on. And they're also confident on achieving still healthy margins because they are one of the few developers who had land bank earlier on the cycle. So they're able to work more on their flexibility, have more flexibility in terms of the margins that they're able to get in this subdued market. So besides growing organically, they also have a few PPS structures in place, and even with them potentially liquidating all the PPS structures, there's possibility of them acquiring listed and unlisted real estate platforms. So that's another area where their ROE could increase from. And also, as I mentioned previously, that AEIs are on the way for Republic Plaza and also other AEI targets. So that's also upside for the organic growth. So overall, we maintain accumulate with a target price of $11.82. This is slightly lower from the previous target price, mainly due to a change of analyst. Guangzhou is not here, so I'll just flash through his slides for China Everbright. Oh, sorry, he's here.
Hi, it's Guangzhou here. So next is China Everbright Water's 4Q results update. So we maintain our buy call with a higher target price of 48 cents, and the last turn price was 36 cents. So if we look at the results here, actually 4Q continue to improve compared to last quarter in 2017. So the positives are that China Everbright Water secured 19 new projects in 2018 with a total investment of RMB 3.6 billion. Meanwhile, there were 18 wastewater treatment projects received tariff hikes ranging from 1% to 165%. And it is worth noting that recently Everbright Water successfully issued the 3rd tranche of Panda bonds. So the aggregate principal amount was 700 million RMB with the coupon rate 3.89%. This is the lowest coupon rate compared to the previous 2 tranches. So together with the previous 2 tranches, Everbright Water already issued Panda bonds with a total amount of 2.5 billion RMB. So with these watches, Everbright Water can expand their business in terms of upgrading and expansion of the existing wastewater treatment plants, as well as explore the new business in other regions. But the negatives is that the daily design capacity was flat because a few years ago the management mentioned the target is to increase the capacity to 10 million cubic meters by 2020, but based on the current capacity, it's very difficult for them to achieve it via the organic growth which is the upgrading and expansion of the existing plants. So the outlook for Everbright Water is quite upbeat. The management will explore other regional markets such as Pearl River Delta as well as the Great Bay Area, because right now the China Everbright's water footprints mainly located in is mainly located in the northern part of China. Moving on, they will level up technology application. So these will help them to improve the operations. And lastly, this year the environmental policies will remain tight, so it will be quite favorable for this company. Next is the Sembcorp's 4Q results update. So we maintain our neutral with a slight higher target price of $1.76. So the positives in 4Q was that Sembcorp penetrated into renewable energy market. So they secured 2 projects for an offshore wind farm to construct the substation topsides. And meanwhile, they won a design and construction contracts for the battery power ferries. And also the SID Brazil's drill ship contracts update was that the company already received approval by its creditors, which is the sale of the 4 drilling rigs being built at the 2 Singapore yards. However, the negatives are that the gearing hit the all-time high as of December last year. 1.44. The gearing of 1.44 is the level that the management felt a bit uncomfortable. So moving forward, they try to bring this down. And also the net order book continues to shrink because last year they only secured 1.18 billion worth of contracts. So it missed our expectations of 2.5 billion. Also, as of end of last year, the floating LNG segment yet have secured any new orders. So the outlook for this company is still quite looming because the E&D capex from the global oil majors is quite moderate this year, only 5 to 10% growth in this year. So Sembcorp will continue to ride through the extended cyclical downturn. So next is the US weekly update.
Hi, thank you, Gong Zhi. So right now I'll cover the US weekly. So for macro last week, the durable goods orders posted a 1.2% advance in December 2018, but much of the strength actually came from the surge in demand for commercial aircraft, which is a very volatile sector. The durable goods orders has been weak since August 2018, and this weakness is usually due to a cutback in demand for the US exports of manufactured goods, which may reflect that there is higher tariffs many countries have imposed on US goods in retaliation for the tariffs that Trump has imposed on them. As for the orders for non-defense capital goods excluding aircraft, there was an unexpected decline and was down 0.7% as compared to the consensus of increasing 0.2%. So this is due to the declining demand for machinery and primary metals, pointing to a further slowdown in business spending on equipment, and that may hamper economic growth. And this business spending on equipment has been slowing since the second quarter of 2018, despite the White House 1.5 trillion tax cut. So the week ahead, the GDP growth rate will be coming out, and we'll see how the economy is currently doing for the first quarter. The initial jobless claims also decreased 23,000 to 216,000, and it was lower than expected for the week ended 16 February. As for existing home sales, it is currently at a 3-year low. And in January, there were 1.59 million previously owned homes on the market as compared to 1.5 million in December. And the average home stayed on the market is 49 days, which is a week longer than January 2018. So it is shifting from a seller's market to a buyer's market, and there is higher supply than demand. So the home prices is likely to remain depressed. But the lower mortgage interest rates, coupled with the moderating home prices, is likely to boost housing affordability for the coming quarter. As for corporate news, Walmart did better than expected and reported an EPS of 1.41, while sales rose 2% in line with expectations. US Walmart same-store sales climbed 4.2%, while the Sam's Club comps increased 3.3%. But most of the growth came from the e-commerce sales, which was up 43%. So it is likely that for the upcoming year, e-commerce is likely to be the growth driver for Walmart. But the stocks fell last week because there was regulatory concerns about the sale of Asda to Salisbury, and because of the regulatory concerns, it may not go through. So the consensus price for Walmart is currently at 110 USD. As for Kraft Heinz, it shocked the market because it suddenly wrote down 15 billion for its brand equity and cut its dividend by a third to 40 cents. It missed both its EPS and revenue figures. As for its EPS, it fell 6.7% year-on-year, as gains from the lower taxes were more than offset by lower EBITDA and higher interest costs. They are also facing a subpoena from the SEC regarding their accounting policies for procurement. So the consensus target price is currently at 40 USD. And for the week ahead, some of the key indicators to be released will be the Fed chairman testimony, the GDP growth rate, and on the 1st of March, there will be a few indicators such as personal income, ISM manufacturing PMI, and the University of Michigan consumer sentiment. So this is the list of upcoming earnings release. The key one to take note will be Berkshire Hathaway, which is coming out today. And Berkshire Hathaway just reported a 4 billion loss because of Kraft Heinz. They have a 27% investment in associates in Kraft Heinz. So right now I'll pass my time to Jerry, and we'll talk more about the China market.
Thanks, Edmund. For China last week, the headline is China government issued the guide document about how to develop the Great Bay Area. I will give the brief introductions later. For the economic indicators, China's January credit numbers beats the expectations, shows the liquidity problems has been easy. For stock recommendations, our Hong Kong research team recommend the China Educations Group and Huawei Autos. For China Educations Groups, our research staff thinks the easing policies environment will give the valuations the corrections. So they give the P ratios back to 30 times, which is the average of the past. This week we are waiting for the China's February PMI numbers. I will give the brief introductions about the Great Bay Area development. The Great Bay Area includes the Hong Kong's, the Macau's, and the 9 cities in Guangzhou's. In this document, the government set the 4 central cities and mainly focused on developing the main functions for these 4 cities. For Hong Kong's, is to first develop its international finance, the shipping and trading centers. For Macau's, is the first developed its tourism centers. For Guangzhou's, the focus on building an international metropolis. For Shenzhen's, is continued to develop its innovation cities. The reasons why develop the Great Bay Area is important because the Great Bay Area's GDP growth is much higher than China's GDP growth rate, and we think with the further consolidate of the resource will give the momentum for this GDP growth. As for the stimulate policies to develop this kind of industries, we're looking forward to the government will issue this kind of policies later. This is a list of stock recommendations of Hong Kong research teams, and we added Huawei Autos and the China Education Group. I will pass to Paul for the Singapore Weekly.
Okay, yeah. Thanks, Mike. Just an update of our usual weekly update. In terms of the Singapore macro, I think without having to beat a dead cat, I think things are still very weak. The exports in December was down 10% in Singapore. I think this weakest in more than 2 years. And the one positive was that actually construction sector seemed to have a very strong rebound. Actually, 2018, the 23% jump in contracts awarded was the highest in more than 10 years. In terms of some corporate updates, these are stocks we don't cover, but we did attend some of the briefings. So we just give you our views. I mean, this is not our official PSR views because we don't give any coverage, but this was some of the commentary that we heard. Anyway, for Genting Singapore, it looks interesting because the valuations are quite cheap, especially if you strip out their 3 billion net cash and you get a 3% plus dividend yield. The fourth quarter earnings was hurt because they accelerated some of their provisions. I think some of the rights in the park, I think they probably think that the useful life is actually shorter than it is. So there was some one-off expenses. And then probably there's some upside from Japan because, as you know, there's bidding activity for the Japan casino. If they win, of course, there will be a perk up in the share price. But even if they lose, then you know that they got 3 billion in net cash. They probably need to they need to dividend out some of this cash, especially because their parent is actually bidding for some casinos. So the parent also needs some money. So there could be some upside in dividends even if they don't get the Japan. And another near-term catalyst for Genting is there's a new almost 800-room casino, 800-room hotel by Far East. So this will actually provide some load into their casinos. As you know, at Resorts World, they're actually running short of hotels or hotel rooms. I think their occupancy is 95 or 98%. Some obscene number there. Okay, and the other news coming up for Genting will be capex for the new redevelopment. There's going to be a new attraction at Resort World Sentosa. It should be released in the first half of 2019. They didn't mention what is it, but they expect some new attraction for Resort World. Okay, I'll just quickly move on to Wilmar. Again, we don't cover, but these are some of the key points. I think the results was very big. I think first quarter will also be weak for them because what's happening is that they've been hurt by, there's an African swine fever in China. as a result, there's going to be there's going to be less soybean crushing. What happens is that they actually import soybeans. For those who don't know, they import soybeans and they will crush it for the meal to feed the swine or pigs. But because of the swine fever, obviously there's a collapse in demand for such meal, and that will affect their utilization rate and their business. There's also this drop in basis point, but I won't go so detailed for that. But the upside for them is probably they're going to list their consumer arm in China sometime this year. They didn't specify the date. In terms of why we don't cover Wilmar, as you know, the margins for Wilmar for the various division is extremely volatile. It swings quarter by quarter, and it all depends on their inverted comma kind of timely purchases of raw materials. Yeah, basically how they take position on some of the commodities. Okay, I move on to Hype. We also attended Hype's briefing. I think why you saw a big rally in the share price was because they gave the guidance for 2019 was for flat profit. So you're assuming 100 million net profit for FY19. Against the consensus was very bearish, about 60 to 70 million or 67 million. Why, as you know, they're very tied to Apple iPhone components. But what has happened is that they've secured quite a big project for a wireless power adapter project, and this will actually support their 2019 earnings. But again, similar to Wilmar, I think their first quarter earnings will also be weak because they've guided that I think there was a very strong number the prior quarter. In terms of tactical, we think that there could be some pause in the rally that we see. I think if there's some conclusion for the negotiations, I think the market could take a pause until we see some better economic data. Yeah, and of course, inflation is just a comment. I mean, inflation is going to be a very important economic barometer. I think the market is pricing no rate hike, but if inflation surprises, there's something that could actually negatively surprise the market. In terms of some of the key events, I think I already mentioned, but the other one to watch is actually this Section 232 or auto tariff. So far, the investigations on auto tariffs is submitted to Donald Trump, so he could actually anytime announce, as you know, it's Donald Trump, so he can actually announce something of an auto tariff on especially some of the European autos or European auto parts. So this could actually negatively hurt the market. His deadline is up to 18 May. Oh, okay. I think that's it for us. If there are any questions, yeah, please, you can just write them in. Thank you.
Hi, someone asked to flash the DBS slides again, so just flashing through it. Anyway, the PDF and this recording of the webinar will be available on our Stocks BNB website.
Oh, okay. Hi. Someone asked about the OCBC. Okay, I'll just speak on behalf of Minion. I think what happened for OCBC's fourth quarter results was that firstly was the investment gains. There was a big collapse in the investment gains. And the second thing was there was also you can't see it from here, but there was a big jump in their provisions also. And also their dividend yield, they didn't, compared to the other banks, their dividend yield is only about 3% plus. So as a result of all these three things, I think they reported the weakest earnings among the three banks, and also the dividend yield is one of the lowest. So as a result, that was one of the reasons for the sell-off. Yeah. Thanks.
Hi, there's a question on CDL, the reasons for the price drop. So the possible reasons could be because of the headline figures. Let me just flash through back to the CDL slide. So CDL, the headline figure, as you can see, is a very big drop. Even for the PATMI, there was a very big, close to 70% decrease. This was, as what I mentioned earlier, for the impairment loss. But if you strip that out, it's actually a gain for the PATMI. However, of course, the market would just take the headline figures as a indicator of the company's performance. because it requires a little bit more analysis to see the true organic growth of the group. And also, I think something to note is that for Singapore property, CDL is probably the biggest true reflector of Singapore property. So you can sort of see the sentiment on Singapore property reflected in CDL's share price. Hi, there's a question on the Brexit effect on CDL. So CDL has quite a big exposure in the UK. So for hotels, they're exposed via their REIT, CDL HD, and for commercial, the recently 2 acquired properties in London. So if you follow the news, there's actually quite a bit of expectations for devaluation and also recession, especially if there's a hard Brexit. So assuming this hard Brexit in fact does go through, in fact, if this hard Brexit does happen, then there will be a negative effect for the currency. However, also to note that they've already forecasted that there's a upside in rental. So it won't be a full impact of the devaluation. It'll be a little bit of offsetting impact. Okay, since there are no other questions, we'll end the webinar for today. If you have any residual questions, feel free to go on our website, Stocks BNB. Thanks, bye.